India, and also if I can throw in an ABB, give us a view on that one as well.
Yeah, I think Cummins has done reasonably well. I remember, I think, tracking the stock just about a couple of weeks back when the stock had gone to a breakout above 4,000 levels. That was the time when the stock was going to a consolidation, but now it's moved up quite well from 4,000 to 4,400 thereabouts. In the same breath, I think ABB has actually underperformed. The stock is still struggling at the 5,000 mark. I think 5,150 is where the stock is. Just about a couple of days back, the stock was almost at 4,800, 4,900, kind of a zone. So it's recovered, mildly in the last few days. But then the medium-term charts for ABB are complete contrast to what we've seen for Cummins. Cummins is a more stronger name. The stock has done exceptionally well, and it looks like that even at current levels, the stock would continue to move up higher and show those leadership qualities.
Okay, all right. So, uh, that's the take coming in on Cummins. Mayuresh Joshi at this point joining us, head equity at MarketSmith India. Rather MarketSmith India. Mayuresh, hi, good afternoon. Give us a sense within this play of cap goods, and as part of the capex cycle, power, would ABB and Cummins be a good play, or would you go towards the pure power players like a Power Grid and Power Gencos, or would you go with the power financiers?
Afternoon, Harsh. No, I think looking at the landscape in terms of expectations of renewable, actually expected to hit 500 gigawatt as per the central government targets by 2032. I think if we are on that path, I think the expectations in terms of all three segments of the power ecosystem, whether they are generators, transmitters, or financiers, all probably come into play. And let's not forget the EPC players as well. 'Cause, for all these elements to be put together, the EPC players, which are probably providing services to the power guys, are probably in the right areas as well. And therefore, I think from a generation perspective, our own sense is that if you're looking at PSUs within the entire basket, obviously, I think NTPC is expected to increase its fair share of solar energy as well as hybrid energy as well over the next few years. The capex is happening in the right direction, and therefore, I think a large part of the expectation builds up in terms of both for NTPC and Power Grid as a transmitter, in terms of capex, in terms of the expectations in terms of capital expenditure to the capitalization trend. I think will continue on an elevated level. I think players like ABB, Cummins India obviously have a lot of other areas that they probably will benefit from as well. Storage units, storage centers, data center development. We've also got some area in terms of niche applications that have probably got in railways. And therefore, I think these ancillary players do come into picture as well. Financiers, again, I think should probably have a reasonable say going forward. But largely, it really depends in terms of the entire ecosystem and the way I think the power generation demand plus dynamics in terms of addition of power that probably happens. At this point of time, Harsh tempted from the PSU space. Anybody holding NTPC Power Grid should hold on. Dividend yield becomes an added advantage. Generators, specifically companies like Tata Power on the private space, are probably looking better placed with expectations of resolutions happening on a couple of their plants, both in terms of tariffs and a part of their contingent liabilities going away, if any. Financiers well placed, dividend yield also remains strong. But again, financiers will be a longer term play. One can't play financiers from a short to medium term perspective.
But Mayuresh, sorry, but why do you say that? Because financiers are trading at nearly a one-time kind of book, maybe 1 or 2 years forward, but one-time book seems reasonable with the kind of dividend yield that they have.
No, so I think the perspective, Harsh, is pretty simple here. The logic that and the rationale that goes behind this power projects are long gestation projects. Obviously, as financing starts coming in, you can't see the implied results come through on an immediate basis. If there are any execution delays that probably happen on a few projects that have probably got funded, or some element of cost overruns, I think that is where the inherent issue probably lies from an immediate short to medium term perspective. And therefore, the logic here is that it might be a little bit bumpy from a short to medium term perspective in terms of how numbers can play out. That one really looks at. I think consistency over a longer period of time be well pulled up over the next 4 to 5 years. No two ways. I think valuations are obviously in favor. And as I said, dividend yield for both these stocks probably look very, very attractive at this time.
What's your take on the power financiers, Kunal? PFC, REC, IREDA?
Yeah, these stocks have grossly underperformed, over the last many months. In fact, PFC, RSC have been languishing at their, 52-week lows as such for the last, I think, 4 to 5 months specifically. Now, there comes a point in the market when, eventually these stocks will also find their mojo back. The risk reward starts to look attractive. I sense that we are looking at a point where these stocks have come back to that kind of a territory where the risk reward starts to look attractive. In fact, over the life thereabouts for PFC, and closer to 385, 390 odd for RC, I think have been zones where the stocks have formed a near-term bottom and shown good rallies. But this time around, I would probably expect that with the markets doing fairly well, you might probably expect that these stocks may go into a turnaround mode, from current levels. So it's a matter of time. One has to be patient enough because it's difficult to anticipate when these stocks would form a bottom. They are, high beta in nature, and especially at times when these stocks find their momentum back again. So I think right now we are at a point where these stocks are not or nowhere close to their momentum zinc. But I think once the momentum is back, these stocks can move up very, very quickly. So risk reward wise, price wise, extremely attractive at current levels.
Okay. Mayuresh, we are very, very close to all-time highs. We're less than 50 points away from all-time highs now. Do you believe that the earnings cycle may turn out to be better in H2 than in H1? We also have put behind the Q2 earnings, not had a conversation with you since, and we've put behind all of the commentary that's come as part of Q2. What's your sense with regard to H2 and FY27 in terms of earnings? Could earnings actually surprise on the upside versus consensus?
So once again, I think H2 is expected to be relatively better because Q2 was resilient as far as earnings go for India Inc. And therefore, I think with GST rationalization expected to play its part, and the expectations in terms of personal income tax cuts also supporting discretionary spending, government capex expected to continue remaining strong as we speak. Tax collections expected to remain resilient, and therefore I think both the fiscal and the current account deficits expected to remain in the trajectory that the government is expected to maintain. Liquidity remains strong. Corporate debt to GDP levels probably remain pretty resilient as well. And therefore, I think if you have a construct done in terms of consumption plus investments, both from the government side as well as private capex coming back, I think that is going to create an impetus in terms of the earnings cycle actually improving as we head into FY27. As we head into the next 2 quarters and end FY26, obviously GST rationalization, consumer discretionary spending, green shoots seen in private capex, and government capex continuing should support earnings. Where the belief, Harsh, was that we might actually grow in higher single digits. I think if we start growing in double digits, which seems to be a base case scenario now, and if that compounds in FY27, I think a large part of the street consensus is a 13-14% earnings growth. If you map that up in terms of the Nifty EPS as we exit FY27, the markets are then not looking very, very expensive. Obviously, I think they're a tad bit above mean averages. But again, I think the expectation in terms of India as a market where earnings will remain resilient. And if any, the resolution that happens on the US tariff fronts, where the expectations of a GDP hit was a foregone conclusion, I think if that gets retraced back with all these factors at play, I think you're probably going to see nominal GDP grow at a much faster rate, leading to the base case scenario of a 13-14% earnings growth. So yeah, I think second half better, FY27 base case 13-14% earnings growth.
Okay. All right. What we'll do is we'll step into a short break. But, we've taken a fundamental view on what happens or what the outlook is if the markets notch up and breach those all-time highs. I want a technical view as well. Kunal, we've seen 5 to 6 times 26K being a key hurdle. I'm going to ask Kunal this question on the other side of this break. Are we now convincingly above 26,000? And can we hit record highs very, very soon? On the other side of this break. Stay with us. Welcome back. Arpit Beriwal, Manager, Derivatives Analyst, Equity Research at Motilal Oswal Financial Services, also joining us at this point. Now, before I go to Arpit, we're around 75 points away now from life highs. But Kunal, really the golden question is that 26,000 was a key resistance. Do you believe that now we've brushed that off for good, or too early to say?
Yeah, I think we've brushed it off for good for the indices. Good support, from the larger cap names is what I would probably believe is a hallmark of this rally. And then look at it this way, Harsh, that the trade tariff thing is not yet settled, and for our markets to climb back to that life highs, irrespective of all of this going around, I think is still indicative of the strength of the internal strength. The numbers on the FII selling on the options, on the FNO side, on the cash side, it's not very, very encouraging in terms of the data point. But then to climb the wall of worries and still, continue to march up higher is probably a test of the litmus test of the strength of our markets. So I think in that sense, yes, 26,000 mark on the short term wise, I think something which should probably have, scaled past. The only, thing which you need to watch out for is that generally at the start of the expiry or a fresh expiry, is where the markets gain significant signs of fresh trend. So if assuming that the end of the November expiry and the start of the December expiry, we trade above the 26,000 levels more or less, I think that will be a very strong confidence booster for the markets going into the calendar year end.
Arpit, would you say that 26,000 brushed off convincingly in your opinion?
Yeah, so very good afternoon to all. If we talk about overall the broader market and the particular indices, so Nifty was struggling from last almost 17 sessions to surpass 26,100 levels. And in yesterday's session, it gave a decisive close about 26,050. And today, slowly, steadily, the benchmark is all close to head towards its previous all-time high levels. So look at the setup-wise, definitely the base of the market has shifted higher. And earlier the resistance was 26,050. That was likely to act as a support for Nifty. And our sense is that slowly steadily the Nifty can head towards 26,350 and then potentially 26,500 in coming sessions as heavyweights are participating well, likes of HDFC Bank, Reliance, Bharti. So definitely 26,050 will be the support level. On the upside, 26,277 and then eventually 26,500 positionally is on the cards for Nifty.
Okay. All right. Mayuresh, let me come to you. What are the sectors that you believe look good from a risk-reward standpoint, given the kind of earnings that have come out? Give us a sense as to what that pocket could be, which could be low-hanging and really easy to grab on.
So Harsh, I think domestic apparel makers, I think they probably are looking a tad bit better placed as we speak. So you've obviously seen better numbers come from V2 Retail, similarly from Vishal Megamart. I think the sweet spot for these folks is that they're absolutely in the right areas where discretionary spending is expected to pick up quite significantly. They've got a good mix in terms of apparel, groceries, and FMCG as well. Their average consumer and the average spending that probably comes through is close to 300, 350 odd rupees. And therefore, I think as discretionary spending patterns move higher in tier 3, tier 4 cities, where a large part of their store count is, and where they're expanding their store count, specifically in the food belt that we're speaking, areas of UP, Bihar, Jharkhand as an example, I think there can be significant value addition that can probably happen to these local players like a Vishal or a V2 Retail. The second element is obviously NBFCs. Our own sense is that with the rate cuts that have probably happened, better placed NBFCs with better capital adequacy and expectations in both terms of better credit rating stand to gain quite significantly as we head to the second half. I think apart from consumer discretionary spending, consumer durable spending with GST rationalization and income tax cuts as a base case scenario expected to trend and tread higher over the next few quarters. And therefore, I think the shift in terms of an unorganized market to the organized players, I think is going to be very, very evident. And NBFCs will probably provide a base case scenario for all these consumer durable players directly or indirectly. And therefore, players like Shriram Finance, as an example, Chola Investment, Bajaj Finance, can benefit both in terms of the rate cut cycle, where borrowing costs go lower, NIM spreads expected to remain significantly higher, and expected to perform reasonably well. Obviously, I think select hospital stocks is something as a space that we've continued remaining very, very optimistic about. Again, GST rationalization helps them to a certain extent. The new visa changes that will probably happen, medical tourism still a very, very small component in terms of overall revenues, should start contributing. And again, I think the asset light model that a lot of these hospital players are probably adopting will probably lead to better dynamics in terms of earnings going forward. So Apollo from the large cap names, Fortis, Max Healthcare should continue doing well. As a proxy to consumer discretionary, Harsh, I think select FMCG stocks should also do well. I think Nestle India had an outstanding set of numbers in Q2. I think the expectation that the management has put forth across their product segments in growth can actually come through for the sector as a whole. And therefore, the next 2 quarters are going to be interesting. We've already discussed a few capex themes, including PAR. And therefore, I think select capex themes should continue doing well as well. So, in our opinion, I think earnings for these sectors should hold.
Right. Mayuresh, a quick follow on. There's plenty of chatter about the possibility of hospitals actually being told to scale back on the kind of price increases that they've been undertaking, especially over the last few years. And now we've seen hospital stocks trade at slightly elevated multiples as well. So just trying to get a sense, is that a very real risk, or do you believe that that won't be much of a risk?
I think that component always stays, Harsh. But again, I think if you probably look at the macro dynamics for the sector as a whole, I think it's still a very, very underpenetrated sector. I think healthcare services in India seems to need to expand quite meaningfully across the length and breadth of the country. And that's what a lot of these hospital players are doing. Obviously, I think the capping in terms of rates that happen as they go deeper in tier 3, tier 4 towns is obviously going to be there. But they're again going to follow an asset-light model out there, which means not excessive leverage, play out with a local partner, and that is probably going to assist the absolute EBIT that they're probably expected to make. You look at the ratios, Harsh. It's still very very low compared to the density that we've probably got. Doctors that are servicing our overall population, the support staff, including nurses, the medical equipment that also is probably needed in terms of providing expertise as an assistant to the medical staff. So the ecosystem has to probably evolve. The government understands the need for all this, and therefore, even if the capping probably happens, I think there is significant amount of opportunities for the listed players that probably exist within the space itself.
Okay, all right. That's on hospitals, healthcare. It's very positive. In fact, from the sub 6,000 keys, Ayesha, this one is going to 10,000 keys. So you're going to see a very strong growth by FY30. And this has been one of the key reasons why Mahindra Holidays hasn't done as a stock hasn't done as well as some of its peers, because growth has been a challenge. Getting in new members has been a challenge. First, let me take a view from Arpit Beriwal. Arpit, on the charts, how is the Mahindra Holidays looking?
If you see overall the chart structure of Mahindra Holidays, if I look at the chart structure on the monthly time frame, the stock is forming lower high structure from last couple of months. However, we have seen good recovery on the weekly time frame in last couple of days from 305 levels to 330 levels. But looking at the overall chart setup, as 345 would be a major hurdle level. Any closing of 345 will definitely start the up move towards 360, 365 levels. So 345 would be a crucial hurdle level on closing basis, where we can see upside move towards 365, where on the downside support will be seen around 320 levels.
Right. Okay, that's that on our Mahindra Holidays. Hold on to that thought, Arpit. We're going to take a very quick break. Come right back. We'll continue tracking markets. Back with closing trades right here on ET Now, and still in conversation with Mayuresh Joshi as well. Mayuresh, wanted to understand what is it that you're making of, some of the moves that some of these hospitality players are making. You've got Taj on one hand, or IHCL rather, which is now venturing into the wellness space with their latest acquisition. And here you have Mahindra Holidays, which is now getting into leisure hospitality.
Afternoon, Aisha. No, I think a lot of these players are foraying into the wellness category, and I think the wellness category is one category which is expected to grow at the fastest pace over the next few years, both backed by discretionary spending patterns, which are expected to be significantly higher, and the need for probably having these breaks, specifically from an urban stressful lifestyle. Again, I think we obviously have been in discussions with a few players in the unlisted space. So I think the understanding that we are now getting for the sector as a whole, and this space in particular, I think this is one of the fastest growing and the hottest space as far as hospitality is concerned. Obviously, I think individual players are either acquiring organically a few players within the industry itself or expanding into the wellness category on their own. But generally, our own sense is that hotel stocks have a long runaway growth. I think the kind of dynamics that one can look at, similar to hospital stocks, I think the underpenetration is pretty stark. The unorganized market is pretty large. And as rationalization has probably happened, specifically for the hotel players, for room rates below 7,500, I think the competitive advantage probably moves back to the hotel stroke hospitality industry as a whole. So yeah, I think remain constructive. Lemon Tree, as an example, is something that we continue holding. Chalet is also a good proxy for the overall space. Anybody holding Indian hotels should continue holding. A clear disclaimer: we continue holding Indian hotels in our global portfolios.
They have access to more data from the customers now.
Okay, that's an interesting one, that Eternal will be sharing customer data to restaurants directly right now. Eternal holding around that 306 level in trade. But let me welcome on board Sunny Agarwal as well from SBI Cap Securities. Sunny, hi, good to have you on the show. And well, back at all-time highs, or at least counting down to that level. What do you think, Sunny, should investors be doing right now? Are there any fresh allocations that you would be making? IT for a sector, for that matter, has now finally sprung up from the lows. Do you think part of the allocation could go there?
Yeah, good afternoon. Definitely, I think IT, which has been a big underperformer during the last 4 quarters, on the hope of that India-US trade deal, there is a likelihood that guidance in terms of growth outlook is likely to be revised upward, at least for FY 2027, maybe not for third quarter. But that is something which can lead to an re-rating as far as the entire active pack is concerned. Anyway, we have seen there is a significant under ownership as far as IT sector is concerned. So we may see a positive rub-off effect of US-India trade deal on IT demand environment. Within that pack, what I feel is that the companies which are specifically working on ER&D space, so companies like LTTS, Coforge, or for that matter, Tata Tech or KPIT, which are working on niche technology work on the auto side. Those are the companies which can see upgrade in terms of growth outlook, and those companies should be on radar if somebody wants to add IT as a pack in their portfolio.
Okay, that's on IT. Kunal, let's revisit your call. You were the first one to spot it, that, you know, IT is coming out of this slumber and it has much, much higher headroom from these levels. Any individual stocks that you like from IT even now?
Yeah, I think from the larger cap names would still continue to be bullish on the likes of Infosys. So we did a relative strength study where we looked at the better performers and the ones which moved up higher or showed leadership qualities. So I think in that sense, yes, Tech Mahindra, rather HCL Tech stands out to be the strongest, from the large cap IT name below its key moving averages, even on the short term charts. So I think that's where one should be looking out for. The mid-cap IT names, Persistent is undoubtedly one of the best performing name. The stock holding on recently to that 6,000 mark as a breakout. Coforge is also something which has been starting to show signs of a bullish momentum on the upside. The stock is holding on to its key short-term moving averages, and with the strength which is eventually going to come back into these IT names, you'd probably expect Coforge to also start to outperform for itself. There could be also a spate of short covering rally across few of the IT, enabled services names. Look at Tata Elxsi, for example, Oracle Finance. These are the stocks which have been beaten down significantly over the last few months, and there seems to be a point where the risk reward would start to look attractive for these spaces as well.
Okay, quite a few names from within IT there. Arpit, what's your call on IT stocks? Any fresh trading ideas?
If you see overall, IT index has been very much selective. So in last couple of days, you've seen good buying action across the IT stocks. But if you look at the particular mid cap IT stocks such as likes of Persistent, if you see the chart setup of Persistent, looking at the monthly setup, the stock has been a quite outperformer. So yesterday only it gave a range breakout on the weekly time frame of 6,200 levels, and I think slowly steadily the stock can head new life highs towards 6,600 and positioning 7,000. So Persistent would be a first pick. Second would be from the non-FNO space, that would be eClerx. So if you see the chart set about eClerx, the stock is in clean uptrend on the monthly time frame, forming higher rise, higher low structure from last 7 to 8 months. The weekly time frame also it is trading over short-term moving averages. A good base is formed near 4,200, 4,300 levels. So I think slowly steadily the stock can head towards 5,000 and 5,250 plus. So looking at both the setup, eClerx and Persistent would be a preferred pick within the IT pack.
Okay. All right. So that's the take coming in on some of the IT counters. Sunny Agarwal, let me come to you. Now, in terms of hospitality, one stock which is standing out today is Mahindra Holidays, but some of the other hospitality counters have run up. And ITC Hotels, in fact, ran up and has now come off from those highs. Is there a tilt you have towards any of the hospitality counters? And is there a rationale for that? Give us a sense.
Yeah, definitely. I think hotel as a sector continue to look good despite of seasonally weaker quarter during the monsoon. We have seen most of the hotel companies have reported a decent set of number. And when we look forward to a seasonally stronger quarter, which is the December quarter, again backed by weddings as well as the travel, we expect the hotel company to deliver overall pack to deliver a healthy earning growth going forward. So demand continue to outstrip the supply. If I have to choose one of the stock or few stocks among the hotel pack, so Chalet Hotel is the one idea which we like at current market price, wherein we feel the fair value of the business is closer to 1,100 rupees. Again, driven by the 30% key addition over the period of next 2 years, and at the same time the similar magnitude of addition on the commercial portfolio side. So that is something which will drive the earning growth for Chalet Hotel. Lemon Tree, wherein most of its portfolio is undergoing basically refurbishing. So that is coming to an end, and as per the management, we have seen that post refurbishing, there is a likelihood that ARR may inch up by 10 to 15% in the refurbished hotel. So there in Lemon Tree, and in addition to that, a demerger of its asset heavy business that will lead to a basically lean balance sheet going forward. So Lemon Tree, one can look at keeping in mind the price target of 180 to 190 over the period of next 12 months.
Just looking at the large caps, they're holding out quite well. NBCC, after that 3,000 crore rupee order from the Nagpur Municipal Corporation, that's looking good by 3%. Cummins, of course, is holding out well. And then, of course, you've got a Power India, IEX. These are all names which are looking smart. But Kunal, as the large caps begin to put on more weight, could that come at the cost of mid-cap underperformance by any chance?
Not really, Aisha, because in this leg the mid caps have already done reasonably well. The index as such. Now, yes, the constituents of stocks, or rather the mix of stocks have been different. It's not the ones which were doing well the last year. They've done reasonably well. There have been new set of names, new set of stocks which have done exceptionally well. So I think one has to try and just about adjust to the current mix where the markets are going. And I also believe that it's a very good sign that the mid caps are not doing or not going into a gung ho kind of a rally, because that means that the euphoria is nowhere set in for our markets. Even though the indices are perched at closer to the life high levels in terms of a breakout, and that also indicates that there should be more headroom for the indices to move up higher before you see some sort of exuberance creeping into the indices. So as of now, I think I would probably expect that it will be a point where there will be a balance between large caps and mid caps, but there will be a phase going forward once the market goes into more positive news flow across global indices, etc. I think once that happens, the mid caps will start to accelerate more than the large cap names.
Arpit, if I can come to you with regard to Natco, the stock is up 4.5%. Volume led.
If you look at the chart from Natco Pharma, so if you see the setup wise, definitely the stock has been underperformed for the last couple of weeks to months time frame. Looking at the chart setup on the monthly time frame, the chart is in formation of forming a double bottom pattern near around 800 levels. So I think look at the setup wise confirmation will be seen around 888, 890 levels. A closing above 890 would definitely confirm the double bottom formation for an upside move towards 1000 levels, 1020 levels. So 890 would be a key level on the upside. A closing above that will definitely place the short term bottom for this counter with key support around 830 for an upside move towards 950 and then 1000 positionally above 890 levels.
Okay, that's that right now. Let's take a look at the laggards as well. Asian Paints, it seems like that very steady.
Welcome back. You're watching Closing Trades here on ET. Now, let's go across. Sunny Agarwal. Sunny, I want to get a sense from you. Chemical stocks, they've been laggards for a long period of time now. You believe that, and every time we close an earnings season, we seem to get a feel that they're 2 quarters away from a recovery, from a comeback. Where are we at this point where the chemical cycle is concerned, according to you?
Yeah, again, chemical as the entire pack continue to struggle from an weak pricing environment, and unfortunately, that is something which continue to remain an overhang for most of the chemical companies. And again, the thesis remain the same that because of the dumping from China, and at the same time, weaker global demand environment, the pricing environment is on a weaker footing, and that is the reason most of the chemical companies are not reporting a very exciting earnings number. So I think again a work in progress as far as the entire chemical pack is concerned, but few chemical names which are looking good despite of weaker numbers. So one of the company which we like is the PI Industry on agrochemical side. So that is the one name among the agrochemical. On the other hand, Vinati Organic, although there is a pricing pressure, but because of the new commissioning of capacity and under its subsidiary Viral Organic, volume growth is something which will ensure that at least 20-25% growth over the period of next 2 years, that can continue. And in addition to that, Acutaas Chemical is the one company which has reported a very solid set of number in Q2. So we believe that should continue. And Privi Speciality is the one stock which we like among the chemical pack.
Right, okay, that's the take coming in on the chemical space right now. Eicher, of course, is holding out very smart today. The auto pack, of course, has been quite, buoyant in that sense. But Arpit, come in on the charts here. Two-wheelers as well as, the passenger vehicles, clear dominance by Eicher as well as M&M. But what about the others?
If you see overall the auto index has been quite resilient post the GST rate cut. And if you see, though from last couple of weeks, the index is consolidating from the weekly time frame, but there are a few pockets which are totally outperforming. And within that, one of the top pick would be Eicher Motors. So technically on the monthly time frame, the structure is intact of formation of higher highs. On weekly scale, almost from last 6 to 7 weeks, it was consolidating in a tight band between 6,800 to 7,100. But today, looking at the setup wise, definitely the stock is given a range breakout above 7,100 levels. And looking from here on, we can see good upside towards 7,350, 7,500 positionally with key support around 6,800. Along with that, second would be from the auto pack would be M&M. So if you look at the chart structure of M&M, in spite of the auto index was consolidating, M&M is a strong uptrend on the monthly time frame. The structure of the M&M, in spite of the auto index was consolidating, M&M is a strong uptrend on the monthly time frame. The structure of higher lows is intact from last 7 months, and slowly the stock is heading towards new life high territory. So I think M&M and Eicher looks good. M&M can slowly steadily can head towards 4,000 plus levels in next 1 to 2 time frames, a month time frame, with key support around 35-50 minutes.
Okay. And what about Sunny? Where do you sit with regard to two-wheelers? Hero gave some very strong commentary, and some of the and the stock has actually stood out after that. Let's pull up the 5-day chart on Hero, and you'll see what I'm inferring. What's the sense like on a Hero and maybe a TVS, a Bajaj Auto, that set of stocks? Is there a preference you have?
Yeah, so coming to two-wheeler pack, again, our preferred bet continue to remain TVS Motor on the back of very robust volume growth, which we are seeing across all the product portfolio. So we believe the fair value of TVS Motor is 3,800, 3,900 with an investment horizon of 6 to 12 months. Hero MotoCorp, we have seen at least the slide in the market share is something which has been arrested, and at the same time valuations are one of the cheapest in the entire two-wheeler pack. So there is some value buying which we are seeing in Hero Moto post this recent development on volume on the stability on the market share front. So Hero again being a turnaround story in case the company is able to sustain its volume growth number over the period of next 2-3 months, then I think the re-rating should continue purely on the back of relatively cheaper valuation as compared to other peers like TVS or Eicher.
Okay, that's the take coming in on the entire two-wheeler space. Of course, today, taking a look at the losers, this Biocon down about 3.5%. Pretty much seems like it's undone all of the gains that it made last week. Auto Pharma is down, Delivery is down, IIFL and Idea is your rank underperformer today. Almost a 5% downtick is what that stock is currently sitting on. There's, of course, IREDA as well. It's been a little bit of a choppy ride for the stock, not going anywhere. Mazgaon Dock, that's up 2%, and then RVNL, which is holding up about almost 0.5%, that also has been a little choppy, so to speak. But Sunny, what happens to the erstwhile favorites, railways and defense? Do you think in this market momentum there will be new leadership in terms of sectors which will emerge, and then what happens to these two sectors?
Yeah, coming to railway and defense, I think defense is relatively well placed as we speak, obviously on the back of very robust order book and likely execution over the period of next 2-3 years. So within defense pack, PSU companies like PEL, Mazgaon Dock, GRAC are very sitting on a robust order book. And at the same time, Bharat Dynamic, in fact, have reported a very good set of numbers this quarter. So all these companies will be reporting a decent set of earning growth over next 2-3 years. Among the railway pack, we have seen some headwind because of the lack of supply of wheel set for railway wagon manufacturer like Titagarh or Jupiter. But what we believe is that that is behind now, that overhang is behind, and in the second half we should see a very good recovery in terms of earning growth. So Titagarh Rail is the one stop which we are recommending to our clients among the railway wagon pack. Railway EPC, I think again FY26 is likely to be a muted year in terms of execution, and what we are hearing is that margin pressure is something which is likely to prevail in the railway EPC pack because of the increase in competitive intensity. So railway EPC we would like to avoid at a current juncture.
Railways at the current juncture, or rather railway stocks at the current juncture. Sunny, Arpit, thank you so much for coming in and speaking with us, giving us that perspective. We'll